this video, we're going to be taking a look at debtors adjustments from final accounts. So they do appear in every single year. They're very popular, quite a bit more popular than creditors adjustments. So a couple of things before we begin, we need to look at different types of prices that you might come across in the debtor adjustments. So we've got cost price, selling price, and recommended retail price. So you need to know the difference between them. So cost price is how much it cost to make the product or how much it cost you to buy it from your supplier. Selling price will be how much a business sells its products to their customers for, and recommended retail selling price is invoice received from creditor showing a recommended retail selling price, how much your supplier recommends you sell the products to your customers for. Or invoice sent to debtor showing an RRSP, how much you recommend your customer to sell the products to their customers for. So as well, we also need to take a look at VAT and what is VAT. So VAT is value added tax. So it is the obligation of the seller to collect the VAT and forward it to the revenue commissioners. Okay, so let's take a look at how this would look. So sales account, we would credit the sales account, that is revenue. Okay, that is VAT exclusive figure. VAT account, we would put the VAT figure, okay, on the credit side because it's linked with sales, and obviously sales are revenue, we would credit it. And then the debtor account, it is the amount including the VAT. So the 100% of the sales plus whatever the VAT amount is. So imagine if this was 100%, this was 23%, we would put 123% into the debtor's account. Then just while we're there, we'll just take a look at how it would look for a creditor. So it'd be the exact same purchases. We would debit the purchase account because that's an expense account, debit the VAT attached to that purchases, and then we would put the VAT inclusive figure on the credit side of the creditor because that's our liability creditor increasing. So again, if we had 100% in here, VAT inclusive exclusive figure, then we put 23% VAT here into the creditor account, we would put 123%. So that's it. Now these are the different types of debtor adjustments that we might see. Okay, so you could have bad debts written off or recovered, you could have provision for bad debts, you could have a dishonoured check, or you could have a sale or return. And we've seen one where just a bookkeeper made a mistake as well. So a good few things going on there. So bad debts written off is when the debtor has gone bankrupt or went into liquidation and they're not going to pay us. All right, and then recovered is when the debtor who previously was paid off as bad has now paid us, right? They're back in action and they're paying us now. So that is the opposite. So we're happy when that happens. Okay, so bad debts written off or recovered. So a bad debt is a debt that the business has officially written off as being uncollectible from the debtor. Okay, now you might hear the terms bankrupt and liquidation in the exam. So there's only a tiny difference between the terms bankrupt and liquidation. So bankruptcy affects individuals, whereas liquidation affects companies. So bankruptcy is a state during which the individual is considered to be unable to pay his or her debts. Liquidation is a process that distributes a company's assets and shuts down the company permanently. So bad debts recovered after time, debtors back in action and they pay you the debt that was previously written off as bad. So this is brilliant. So just a bit of background here. In 2015, the Bankruptcy Act stated the bankruptcy terms are now 1 year. This means the business's debtors can set up a business again after 1 year of being declared bankrupt. They may ask to trade with the business again if the business trusts them. So to entice the business to trade with them again, they may offer to pay back the previous debt that they owed the business. Okay, so bad debts can be all of the debt that the debtor has previously owed them. So imagine a debtor has gone bankrupt and the debt of €1,000 owed will not be paid. Bad debts written off 100% is recorded like this. So you've got bad debts written off here under selling and distribution, and we are going to subtract the 1,000 from the debtors because we're not going to get that. Okay, they've gone bankrupt. So bad debts can be some of the debt that the debtor has previously owed them. So imagine a debtor has gone into liquidation and they pay only €100 of the 1,000 owed to the business. Bad debts written off 90% would be recorded like this. So you've got your bad debts written off, the €900 that they're not going to receive, okay? You will take the 1,000 away from the debtor, and the 100 that they paid the business is going to go into the bank. So whatever way, the bank is going to be debited, but if you have a bank overdraft here, it will be minus from the bank overdraft. But if you have a bank figure up here, we would plus that €100 there. So the debtor is going to be credited 1,000, and then bad debts written off, the expense is going to be debited 900, and the bank is debited 900. So we've got 1,000 on each side there. 1,000 debit, 1,000 credit. Okay. Bad debts recovered can be all of the debt that the debtor has previously owed them, the debtor had previously owed them, is repaid to the business. So imagine a debtor previously went bankrupt and has just now repaid the debt of €1,000 previously written off as bad. Bad debts recovered 100% is recorded like this. So this is a good situation. So we've got bad debts recovered here under add operating income, and we have €1,000 coming into the bank. So either if the bank is an asset, we'd add it to the asset, but if the bank was an overdraft, we would minus it from the overdraft. So bad debts recovered can be some of the debt that the debtor had previously owed them. Is repaid to the business, and they promise to pay back the rest within the next year. So imagine a debtor previously went bankrupt and has just now repaid €500 of the debt of €1,000 previously written off as bad, and promises to repay the rest. So bad debts recovered 50%, and the promise of the remainder to be repaid is recorded like this. So the 500 that they have yet to repay is going to be added to the debtor's figure. 500 is going to go into the bank. So if it's a bank account, a current asset, so a positive bank, we would add 500. But if it was a bank overdraft, we would minus 500 from the overdraft. And then we put bad debts recovered, €1,000 there into the add operating income. Okay, next we have provision for bad debts. So provision for bad debts is very different from bad debts written off. Provision for bad debts is a debt that the business predicts will be uncollectible and turn into a bad debt. The business is being prudent, which is a fundamental accounting concept. It means that a business should only include revenues in the accounts when realised or certain. They should also include costs when incurred or anticipated. So this ensures that revenues are not overstated or costs understated. So provision for bad debts is a cost that is anticipated. So this means that the business is not understating costs. So provision for bad debts is a contra asset, so it reduces the value of the asset debtor. So provision for bad debts to be created, to be set up. A provision for bad debts had not been created or set up before, so you have to set it up now. But if it says provision for bad debts is to be adjusted to, a provision for bad debts has been set up previously, check the trial balance to see what it was. If you calculate that the new provision for bad debts is greater than the one in the trial balance, this will be an increase in bad debts provision. This is recorded in the selling and distribution expenses in the TPL. If you calculate that the new provision for bad debts is less than the one in the trial balance, this will be a decrease in bad debts provision. This is recorded in add operating income in the TPL. So bad debts provision will be taken from the debtors figure in the balance sheet under current assets. So bad debts provision to be created or set up looks like this. So there's your debtors, 100,000, say for example. So imagine your debtors are 100,000 and you're told to set up or create a provision for bad debts of 5% of debtors. It's going to look like this. So you've got your bad debts provision is a selling and distribution expense, €5,000 there, which you take away from your debtors figure in your balance sheet. So you think your debtors might actually only be €95,000. So that's how setting it up would look, or creating the bad debts provision would look. The entire amount of bad debts provision would go in as an expense. So imagine your debtors are 100,000 and there is already a bad debts provision of 4,000 in the trial balance. If you were told that the bad debts provision is to be adjusted, okay, it would look like this. So debtors 1,000, okay, but the 5%, okay, adjustment, bad debts provision is now 5,000, but it was previously 4. Okay, that's what they had in the trial balance. So that is an increase in bad debts provision, which is €1,000, which will go in the selling and distribution expense. So that's not a great situation there. But imagine that you were to adjust it, and imagine your debtors are 100,000 and there's already a bad debts provision of 6,000 in the trial balance, okay? And then obviously we're adjusting it to 5%. It'll be 100,000 minus 5%, but we compare it to the 6 that was in the trial balance, and that is going to be a decrease in bad debts provision, €1,000 there in ad operating income. So that is a really good situation there. Okay, now we look then at a dishonoured cheque. So what is a dishonoured cheque? So a debtor has previously sent a cheque to the business. So unfortunately, when the business went to cash or lodge the cheque, the debtor didn't have sufficient funds in their account to honour the cheque. So the cheque has been dishonoured. So all the business has to do to resolve this is get on the phone to the debtor and advise them that the cheque has bounced and to arrange a new form of payment. That's all they have to do. So it's not like the debtor has gone bankrupt and they're never going to pay them. It's just that the cheque bounced, okay? The cheque was dishonoured. They didn't have the money currently in their account to pay for that. So imagine a business sent the debtor a cheque for €2,000 and we are told that this has been dishonoured. So this is how it's going to look in the account. So you've got your debtor's figure here. You add the 2,000 back to the debtor because that debtor owes you now again. All right. And then what we do, okay, is we put it out of the bank account. So in is debit side, out is credit side. So if it was a bank overdraft here, we would add the 2,000 to the bank overdraft. But if it was a bank current asset, we would minus that from the current assets there. So then we have sale or return. So we've seen this before in creditors and we've seen it in closing stock. So check out your closing stock videos if you're not sure about this. So this is an agreement between the seller and buyer that states that goods that are not sold will be taken back without having to be paid for. So in these adjustments, the business's bookkeeper enters a sale or return agreement on the 31st of the 12th, whatever, as a credit sale or a credit purchase by mistake. So it's your job now to fix his or her error and unwind it. So to rewind a credit sale, this is what the bookkeeper did by mistake. So they had closing stock minus cost price, sales plus selling price, debtors plus selling price. So how will you fix it? Well, you will add the cost price to closing stock, you will minus the selling price from sales, and you will minus the selling price from debtors. So you're just completely rewinding what the bookkeeper did by mistake. So the agreement between buyer and seller said, if I don't sell this, you don't charge me. So the bookkeeper accidentally did charge it. They put it down in their books as if they were to charge it. Okay, so an example here. Goods were sent to a customer on a sale or return basis on the 31st of the 12th. These goods were recorded in the books as a credit sale of 28,000, which is a markup on cost of 25%. So what we do is we adjust the closing stock in the TPL and balance sheet as follows. So we increase the closing stock by the cost of the goods, which are 22,400, which is 28,000 divided by 125 multiplied by 100. We decrease the sales by 25,000 in the TPL and we decrease the debtors by 28,000 in the balance sheet. So this is how it's going to look in the books. So you've got your trial balance figure, your closing stock figure. It'll actually be the figure that you have been told in the adjustment, and add the cost price here. So add 22,400. And then the sales, you take away 28,000 from the figure in the trial balance, and the debtors, you take away 28,000 from the figure in the trial balance. So we're now ready to take a look at some past exam papers, so some past debtor adjustments. So let's go. So 2021, You can see here that the debtors actually affected 3. So there was 3 adjustments, okay, for this. And you can see here you've got your debtors figure here in the trial balance, and you also have a bad debts provision. So they reckon that of the €97,300 debtors that they have, 3,500 of those euros are not going to be paid. Okay, so then we've got adjustment 2, something in adjustment 7, and then something in adjustment 8. So adjustment 2, goods were sent to a customer on a sale or return basis on the 31st of the 12th, 2020. These goods were recorded in the books as a credit sale of €28,000, which is a markup on cost of 25%. Number 7, part 1. A credit transfer for 1,800 had been received on the 31st of the 12th, 2020 in respect of a debt of 2,500 previously written off as bad. The debtor has agreed to pay the remainder within 2 months. No entry was made in the books to record this transaction. And then number 8, part 2, provision for bad debts is to be adjusted to 6% of debtors. Right, so let's go. So goods were sent to a customer on a sale or return basis at the end of the year. These goods were recorded in the books as a credit sale of 28, which is a markup on cost of 25. Okay, so the bookkeeper should not have recorded them as a credit sale. So you have to rewind the credit sale of 28,000. So how do we do that? Well, we want to add the closing stock back to the closing stock figure. So the closing stock here is €22,400. All right, how did I get that? Well, it is the selling price, 28,000, divided by 125 and multiplied by 100, and then we get the cost price. So that is what we do with the closing stock. And then we have the sales minus 28,000 here, and then debtors minus 28,000 here. Closing stock here in current assets will obviously also be affected there. So then we have number 7, part 1. A credit transfer for 1,800 had been received on the 31st of the 12th, 2020 in respect of a debt of 2,500 previously written off as bad. The debtor has agreed to pay the remainder within 2 months. No entry was made in the books to record this transaction. Okay, so 1,800 came into the bank, which would reduce the bank overdraft there. The debtor has agreed to pay the remainder. The remainder is the difference between 1,800 and 2,500, which is 700. So we're going to add 700 back to the debtors. Then we have to record the bad debts recovered in total, so the 2,500 there. Lastly then, adjustment 8, part 2, provision for bad debts is to be adjusted to 6% of debtors. So you tot up your debtors figure there, and it's 70,000 in total. Multiply that by 6%, and your new bad debts provision is now 4,200. Okay, and then what you do is you have to compare that to the previous bad debts provision that is in the trial balance, and that is an increase of €700, which is not a fantastic situation, but we have to treat it then as an expense. So increase in bad debts provision there, €700. So that is all 3 of those adjustments done. And just remember, if you're adjusting the closing stock figure here, whatever your final closing stock figure here is, you're going to also put it into the current assets. Right, so now looking at the 2021 part B. Okay, so what we have here is we've got 4 adjustments, all right, but there was 2 coming up in one adjustment, so in the bank one. Okay, so part 2, finished goods were sent to a customer on the 31st of the 12th, 2020 on a sale or return basis. These goods were recorded in the books as a credit sale of 16,000, which is a markup on cost of 25%. So 5, part 1, a cheque for €2,000 received from a debtor has been dishonoured. This has not been entered in the books. And then part 2 of that, number 5, a cheque for 7,500 received from a debtor had been entered in the books, the cash book and the ledger as €5,700. And then part 7, provision for bad debts to be adjusted to 4% of debtors. Right, so let's take a look here then. So 3 adjustments there, and we've got our debtors figure here, 174, and our bad debts provision, 5,000 there. So the first one, finished goods sent to a customer on a sale or return basis. Okay, so these were recorded as a credit sale, and they shouldn't have been, because there was an agreement there to say if I don't sell them, I don't have to pay for them. So the bookkeeper did that in error. So to the closing stock of finished goods, we add the cost price of the goods back there. Okay, how did I get this 12,800? It was the selling price, 16, divided by 125 and multiplied by 100. So that is our cost price there. Our closing stock figure finished goods will go down in the current assets as well whenever you have all of your adjustments done. Okay, then there's your sales. We are going to minus 16,000 from the sales. Okay, and then that is the selling price there, and we're also going to subtract that from our debtors figure. So 5 part 1, a cheque for 2,000 received from a debtor has been dishonoured. This has not been entered in the books. Okay, so it's been dishonoured. All you have to do is get on the phone to the debtor and say, come here, you owe me €2,000. That cheque for €2,000 that you sent me has been dishonoured, so send me another one please. At this stage then, that debtor owes you 2,000, right? So you add 2,000 to the debtors, and then your bank is an asset here. You have to record that the cheque was dishonoured. So you'd previously recorded it going into your bank, and now you have to record it going out. So from the asset, which is on the debit side, we minus 2,000. So that's that part. Then the next part, a cheque for 7,500 received from a debtor had been entered in the books, cash book and ledger, as 5,700. So this is what the bookkeeper should have done. The bookkeeper should have had 7,500 coming into the bank and 7,500 going out of the debtor account. So we should have minused 7,500 from the debtor, and we should have put 7,500 into the bank. What they did by mistake was 5,700 into the bank instead of 7,500, and 5,700 coming out of the debtor instead of 7,500. So to fix that then, we would need to add another 1,800 to the debit side of bank, and to get this to here, we need to add another 1,800 to the credit side of the debtor account. Okay, so the bank, we add 1,800, and the bank is here in an asset, so our asset bank would be here, so we add the 1,800, and the debtor, we need to minus 1,800 from the debtor. Okay, so that is adjustment 5 part 2 done. Now what we'll do is we'll do part 7, which is provision for bad debts to be adjusted to 4% of debtors. Okay, so we tot up our debtors figure 158,200 when we adjust all our figures there. Then we multiply that then by 4% to get 6,328, which is our bad debts provision, which we will take away from our debtors figure. And then we compare that to the €5,000 there. Okay, the 6,328 is larger than the €5,000. It is an increase in bad debts provision of 1,328. So increase in bad debts provision there, 1,328 in the selling and distribution expenses. Okay, 2020. So in 2020 there was 2 adjustments. So you've got your debtors here, you've got provision for bad debts, and then our 2 adjustments here. So 7 part 1. So a credit transfer for €1,000 had been received on the 31st of 12th 2019 in respect of a debt of 1,500 previously written off as bad. The debtor has agreed to pay the remainder within 2 months. No entry was made in the books to record this transaction. And then number 7, provision for bad debts is to be adjusted to 4% of debtors. So we go and we put in our debtors and our bad debts provision here, and now we look at our bank one first. So the bank was on the credit side, so 48,800 here. So credit transfer of 1,000 coming into the bank would reduce that bank overdraft there by €1,000. So that was in respect of a debt of 1,500 previously written off as bad. So the debtor's going to pay us the remainder that they owe us. So that's €500 there. So we add the €500 there. And then we've got bad debts recovered, 1,500 in our add operating income. Then we have part 7, provision for bad debts is to be adjusted to 4% of debtors. So we tot up our debtors, they're 98,000. We work out what 4% is. 4% is 3,920, which is 98,000 by 4%. Then we compare it to what we had in the trial balance, which was 4,500. And then we can see that's actually great because that is a reduction in bad debts provision. So it's gone down from the 4,500. So that is a decrease in bad debts provision of €580, which we put in add operating income in the trading profit and loss. Right, 2019, so 3 adjustments here. So in our trial balance, our debtors was 98,200 and our bad debts provision was €4,000 here. So 3 adjustments. We've got number 4 here, then number 8 and 9. Okay, so let's take a look. So it was discovered that goods had been sent to a customer on the 31st of 12th, 2018 on a sale or return basis. These goods were recorded in the books as a credit sale of 7,500, which is a markup on cost of 20%. Okay, so end of the year, this is going to be closing stock adjustment as well. Closing stock will go here in my trading, but it will also go down here in my current assets. Whatever you have here, whatever figure is here, you just bring it over to the balance sheet when you're finished all of your adjustments. Okay, so the bookkeeper recorded the sale or return as a credit sale, and they really shouldn't have. Okay, that was not the correct thing to do. So what we need to do is we need to unwind that. Okay, so the 7,500 was the selling price. We need to add the cost price back to the closing stock figure, which will also go in turn here. So you'll put your closing stock in at the end as well. So 6,250 is added in there. From our sales, we're going to take 7,500 away from the trial balance figure, and we are going to take 7,500 away from the debtors figure. So that is that adjustment done, and you'll also have your closing stock when you have it finished. Then 8.1, so we have a cheque received from a debtor for 5,600 had been dishonoured by the bank. This debtor had been declared bankrupt and had made a credit transfer for a first and final payment of 30 cents for every €1 owed. Okay, so this is a funny one. The 5,600 was dishonoured by the bank, so the bank overdraft of 60,000 would have increased by 5,600 when that cheque was dishonoured. So we add the 5,600 there, and then we're going to minus the credit transfer that was received into the bank. So money received into the bank would reduce the bank overdraft figure. So how did I get this 1680? Well, 1680 is our 5,600 multiplied by 30 divided by 100. So it's the 30 cent in the €1. So minus 1680 there. Now I have to show my 5,600 having to be added to the debtor because of the dishonoured cheque. But then we have to minus 5,680, which is 1680 received into the bank, but the other 70 cent in the euro being written off as a bad debt. So bad debt's written off, 5,600 by 70, that's 3,920. So altogether, we've got debits and credits completely equaling. That was a tough one that year, I feel. Okay, now part 7. Provision for bad debts to be adjusted to 4% of debtors. Okay, so provision for bad debts, we get our new debtors figure, 90,700. We multiply it by 4%, that's 3,628. All right, and then we compare it to what we already had, which was 4,000. So 3,628 is an actual, it's a good thing, it's a reduction in bad debts provision, which would go in add operating income, decrease in bad debts provision 372. Okay, that goes there. All right, moving on then to 2018 manufacturing account. So we have debtors here. Number 2, it was discovered that finished goods had been sent to a customer on the 31st of the 12th, 2017 on a sale or return basis. These goods had been recorded as a credit sale of $17,500, which is a markup on cost of 25%. And then note 4, part 1, a cheque for $1,000 had been lodged directly into the firm's bank account on behalf of a debtor in respect of a debt previously written off. This represented 40% of the original debt, and the debtor has undertaken to repay the remainder in January 2018. And then part 9, part 2, the creation of a provision of bad debts equal to 6% of debtors. Okay, so we'll just take all of them at the same time. So it was discovered that finished goods had been sent to a customer on the 31st of the 12th, 2017 on a sale or return basis. These goods have been recorded as a credit sale of $17,500, which is a markup on cost of 25%. Okay, so sale or return, recorded as a sale or return by accident. So we need to add the cost price of the closing stock back to finished goods, which is €14,000. So how did I get €14,000? 17,500 is 125%. 17,500 divided by 125 multiplied by 100 is €14,000. Then from sales I will minus 17,500, and from debtors I will minus 17,500. For part 1, a cheque for €1,000 had been lodged directly into the firm's bank account on behalf of a debtor in respect of a debt previously written off. This represented...
I didn't catch that. Could you try again?
This represented 40% of the original debt, and the debtor has undertaken to repay the remainder in January 2018. Okay, so the bank figure here is bank overdraft. So 43,600 there. So a cheque for 1,000 was lodged directly into that. So the bank overdraft is going to reduce by €1,000. So then what about the amount that the debtor has promised to repay? So if €1,000 was €40,000, 60% is what the debtor has promised to repay, and that is 1,500 is going to be added back to debtors. The 100% is going to be recorded as bad debts recovered in the trading profit and loss. So altogether we have 1,000 debit in the bank account, we have 1,500 debit in the debtors account, and we have 2,500 revenue bad debts recovered recorded in the bad debts recovered account. Then we have the creation of a provision for bad debts equal to 6% of debtors on the 31st of the 12th, 2017. Okay, so here then we need to create a provision for bad debts, and also, we need to put the closing stock of finished goods. Whenever you're doing your closing stocks, whatever you have here, you'll have down the current assets as well. Okay, so we work out what the debtors figure is. It's €46,000. Multiply that by 6%, and that is 2,760. So that is the bad debts provision. Now this says the creation of, so bad debts provision did not exist before, and it was not in the trial balance. Therefore you're going to put all of this into selling and distribution. So provision for bad debts 2760 will be recorded in there. So 2017, we've got debtors here 70,500, and you've got provision for bad debts 3,500. And the adjustment here, we've just got one this year, adjustment 8. A cheque for €700 had been received on the 31st of the 12th, 2016 in respect of a debt of 1,200 previously written off as bad. The debtor wishes to continue trading with Mullen and has undertaken to pay the remainder within 1 month. No entry was made in the books in respect of this transaction. So we have to record the cheque for 700 coming in, and that is going to reduce the bank overdraft. So that was on the credit side of the trial balance. So 700 coming in will reduce the overdraft. The amount that the debtor has promised to repay us, okay, will be added to the debtor. That is €500 there. Both of those amounts is our bad debts recovered, which we will put into add operating income in the trading profit and loss. So you're putting 100% here, you're putting the amount received into the bank here, and the 500 added back to the debtor there. In 2016, we have our debtors 52,000, and then we have 3 adjustments then. So number 4, it was discovered that finished goods had been sent to a customer on the 31st of the 12th, 2015 on a sale or return basis. These goods had been entered in the books as a credit sale of 15,000, which is a markup on cost of 20%. Then note 6, part 1, a cheque for 800 received from a debtor has been dishonoured. This has not been entered in the books. And then we've got 9, part 2, the creation of a provision for bad debts equal to 4% of debtors. Okay, so let us get started then. So the first part, the sale or return. Sale or return should not be entered as a credit sale, okay, because you have an agreement with the buyer that you don't enter it as a credit sale until they have actually sold goods, okay. So what we need to do is we need to add the closing stock of finished goods back here, 12,500. How did I get that? I got that because 15,000 was the selling price, and that was 120%. So 15,000 divided by 120 multiplied by 100, and we have 12,500. That will also be added to closing stock here. Now I must actually make a note before I publish the notes that it always affects closing stock there as well. So then I need to take away the selling price, which is 15,000, from our sales figure and from our debtors figure. So that is that. All right, next one then, part 6, part 1, we have a cheque for 800 received from a debtor has been dishonoured. This has not been entered in the books. So a cheque was dishonoured. It just hasn't been, they tried to lodge it, but they can't because the debtor didn't have any money in their accounts. What you would have to do is just get on the phone to the debtor and say, I need to get another cheque or another form of payment. There's no bankruptcy or anything like that here, okay. So all we have to do then is record that the 800, it would increase the overdraft, because previously you would have recorded the cheque coming in, which would have reduced the overdraft. So now we have to increase the overdraft again by 800, and we also need to increase the debtor by 800. So we debit the debtor and we credit the bank. Then 9, part 2, the creation of a provision for bad debts equal to 4% of debtors. So we have the creation of a provision for bad debts, right? That had never existed before. So whatever we take away here, we will put into the selling and distribution. So the debtors figure 37,800, multiply that by 4% and you get 1512. And we put the entire 1512 into selling and distribution as a provision for bad debts. So that's all of that done. You just need to remember, put in your closing stock here for your sale or return closing stock there as well. Okay, 2015 question. So we've got bad debts provision 4,000, debtors 99,200. Note 3, the suspense figure arises as a result of the incorrect figure for debenture interest, although the correct entry had been made in the bank account and discount allowed 400 entered only in the discount account. Then note 7, part 2, a payment from a liquidator was received directly into the bank. This represented a first and final payment of 25 cents in the euro in respect of a debt of 4,000 euro. And then 8, part 2, provision for bad debts to be adjusted to 4% of debtors. Okay, so let's get going. So we'll just do the suspense part first, but we'll just look at the one affecting the debtors. We won't look at the debenture interest one. So the second part here, discount allowed 400 entered only in the discount account. So discount allowed would be allowed to a debtor. So we would take away the 400 euro from the debtor figure. Then our two sides would not equal, okay? So what we'd have to do to the item incorporating our suspense, including our suspense, we would need to add the 400 euro there. So take a look at your suspense video and notes in case you're not too sure about what I did there. Okay, so just looking at the debtor part, we minus the 400 from the debtor, and then we would put in the salaries and general expenses plus 400 euro there. Now, 7 part 2, a payment from a liquidator was received directly into the bank. This represented a first and final payment of 25 cents in the €1 in respect of a debt of €4,000. Okay, so payment from a liquidator, all right, 25 cents in the €1, okay, in respect of a debt of €4,000. So that means that it was €1,000 came into the bank. €1,000 would reduce the bank overdraft by €1,000 there. Then we would have the other 3,000 that we have not received will be bad debts written off in the selling and distribution expenses. And we need to minus the whole amount from our debtors there. And that's that adjustment done. 8 part 2, we have provision for bad debts to be adjusted to 4% of debtors. So we tot up all of our debtors here, which are 94,800. We will multiply that by 4% and we get €3,792. We compare that then to the bad debts provision that had already existed there. And we can see clearly that that is a decrease in bad debts provision, which is great. Decrease in bad debts provision there, €208. So that is a really good sign there. Okay, 2014, only one adjustment here, but you also have your provision for bad debts, and which you would put that in at the start in your step 2 when you're transferring all your figures in. But note 9, a cheque for €800 had been received on the 31st of 12, 2013 in respect of a debt of €800 previously written off as bad. No entry was made in the books to record this transaction. Okay, so it was in respect of a debt of €800 previously written off as bad. So somebody is giving us a debt back. Okay, so somebody, a debtor that didn't pay us, right? Their account was reduced by 800 and the bad debts written off was increased by 800, but now they're paying us, but they paid us into the bank. So that is going to decrease the bank overdraft by 800 because 800 come into the bank, decreases the bank overdraft figure. And we need to show the bad debts recovered 800 there. There is no effect to the debtor because the debtor that had previously been written off as bad, they paid us all of the amount that they had previously written off. So that was that. Right, 2013, note 2. Finished goods sent to a customer on the 31st of December on a sale or return basis were treated incorrectly as a credit sale. The recommended retail selling price of these goods was €6,000, which is cost plus 20%. Note 5 part 2. A credit transfer of €800 had been paid direct to the firm's bank account on behalf of a debtor who has been declared bankrupt. This represents a first and final payment of 20 cents in the €1. And then 7 part 2. A provision for bad debts to be created equal to 4% of debtors. Okay, so let's get started. Finished goods sent to a customer on December 31st on a sale or return basis were treated incorrectly as a credit sale. The recommended retail selling price of these goods was €6,000, which is cost plus 20. So the bookkeeper incorrectly treated a sale or return as a credit sale. So we have to unwind the credit sale. So we are going to add the cost price back to closing stock of finished goods. How did I get this cost price of €5,000? Well, the selling price was 6,000, okay, which is cost plus 20. So you divide this 6,000 by 120 and multiply it by 100 and you get your 5,000. That closing stock figure would also be taken away here whenever you get your closing stock final figure from here. So you just bring it down as per there as well. Okay, and then your sales, you're minusing the 6,000, and from the debtors, you're minusing the 6,000 as well. Right, then we have a credit transfer of €800 had been paid direct into the firm's bank account on behalf of a debtor who has been declared bankrupt. This represents a first and final payment of 20 cents in the €1. Okay, so €800 paid into the bank account is going to reduce the bank overdraft figure. All right. So this represents first and final payment of 20 cent in the €1. So 800 is 20 cent or 20%. They're not going to receive the other 80%, which is 3,200. So that's bad debts written off here, 3,200. And then we're going to reduce the 100% from the debtors, which is €4,000 there. Then 7 part 2, a provision for bad debts to be created equal to 4% of debtors. So your debtors figure here, 92,600, multiply that by 4%, we get 3,704. It has to be created. That means it didn't exist before. And if you look at the trial balance, there was no bad debts provision there. So bad debts provision is going to be taken away here. So that is in selling distribution expenses. That is all 3 of those adjustments. And just remember, put your closing stock figure here when you get it all finished as well. Okay, 2012. The suspense figure arises as a result of the incorrect figure for debenture interest, although the correct entry had been made in the bank account and discount allowed $450 entered in the discount account. 5 part 2, a credit transfer of €900 had been paid direct to the firm's bank account on behalf of a debtor who has recently been declared bankrupt. This represents a first and final payment of 30 cent in the €1. And then 8 part 2, provision for bad debts to be adjusted to 4% of debtors. Okay, so let's go. You can see you've got debtors there, 98,400, and bad debts provision there, 3,000. Okay, so we take the first one and we're just looking at what impacts the debtor here. So we won't be looking at the debenture interest. So just the second part of this. Discount allowed $450, entered only in the discount account. So we also need to take it away from debtors in the debtors account. And as you know, if you've watched all the suspense videos, that the two sides will not equal if we minus 450 from one side, from the debit side. So these always need to equal. So in order for this to equal, again, our item incorporating suspense, we will plus the 450 there. So then we'll put them into the accounts as so. Just slot them in as you see them. So plus 450 here and minus 450 here. 6 part 2, a credit transfer of €900 had been paid direct to the firm's bank account on behalf of a debtor who has recently been declared bankrupt. This represents a first and final payment of 30 cent in the €1. Okay, so credit transfer of €900, that reduces my bank overdraft by €900. So it's been paid directly into the firm's bank account on behalf of a debtor who had recently been declared bankrupt. So that is 30 cent in the €1. We're not going to get the other 70 cent. So bad debts written off, €2,100 in selling and distribution. And then we take the 100% off from the debtors. So we minus it by 3,000, which is the 900 that they sent us, and the 2,100 that they're never going to send us. Last adjustment then, 8 part 2, provision for bad debts to be adjusted to 4% of debtors. So our debtors, we tot them up, 95,950. We then minus that by 4%, we get 3,798. We will compare that to the previous bad debts provision from the trial balance, and that's an increase in bad debts provision, which is an expense. So increase in bad debts provision, it increased by €798, so we have to treat that as selling and distribution expense. In 2011, we have 2 adjustments, but this is a bit tricky because the second adjustment, actually has an effect on the first adjustment. So let's have a look. So part 5, a bad debt of €450 should be written off and a provision for bad debts should be provided at 5% of debtors. And then 6, it was discovered that goods which cost the firm $5,400 to produce were sent to a customer on a sale or return basis. In error, these goods were charged to the customer at cost plus 25%. Okay, so we'll do the first part first. So the bad debt of $450 should be written off. So bad debts written off here is selling and distribution expense, so $450 here, and then we minus the $450 from the debtors. Now we can't do the next part, provision for bad debts of 5%, until we finish off our debtors figure And the next adjustment affected our debtors. So it was discovered that goods which cost the firm 5.4 to produce were sent to a customer on a sale or return basis. In error, they were put in as a credit sale. Okay, so they were charged to the customer at cost plus 25%. So we need to add the cost price back to the closing stock of finished goods, which is 5.4. That will also go down to the current asset. So we'll have closing stock here as per the TPL, whatever the final figure is here, we just slot that in there. But then we need to find out what the selling price is and take that away from sales and take it away from debtors. So 5.4 is what it cost them to produce it, and the selling price was the cost plus 25. So 5.400 multiplied by 125% is 6,750, which we take away from sales and which we take away from debtors. So that's given us a final debtors figure there of 47,400, which when we multiply by 5%, we will get a bad debts provision of 2,370. Okay, and we have to say to ourselves, what do we do here? There was no bad debts provision previously. Okay, so it had to be set up, or I should be provided. So 2,370 needs to go into selling and distribution there. All right, 2010. So we only have one adjustment here in the 2010, but we have debtors here and we have bad debts provision here. So note 9, a cheque for €400 had been received on the 31st of the 12th, 2009 in respect of a debt of €900 previously written off as bad. The debtor has agreed to pay the remainder within 1 month. No entry was made in the books to record this transaction. Okay, so we've got the debtors and the bad debts provision here, 1,900. So a cheque for 400 had been received. So the bank overdraft here, we minus the 400. Okay, and then the debt was 900 previously written off as bad. The debtor has said they will pay us the remainder. So we add the 500 back to the debtor because they've promised they will pay us. So they're back in action with us again. We add the 500. So we had previously minused 900 away from these debtors figure. So now we're adding the 500 back. And the bad debts provision in operating income is the whole amount, which is €900 there. Right, 2009. So 3 adjustments here. So we've got the debtors figure here, we've got a suspense, we've got a bad debt, and then we've got the sale or return. So the suspense figure arises as a result of discount allowed €200 entered only in the discount account, and of the posting of an incorrect figure for the debenture interest paid to the interest account. The correct interest was entered in the bank account. Then number 5, a bad debt of €500 should be written off and a provision for bad debts should be provided at 5% of debtors. And then number 6, it was discovered that goods which cost the firm $6,500 to produce were sent to a customer on a sale or return basis. These goods were charged to the customer in error at cost plus 20%. Okay, so looking at the suspense one first. Suspense figure arises as a result of discount allowed 200 entered only in the discount account. So discount allowed also has to go into the debtor's account because it was reduced the debtor by €200. So we minus €200 from here. My trial balance will not equal if I minus 200 from the debit side, okay, and then do nothing else. So I go to my item incorporating suspense and I add 200 to that, and now my debits and credits will equal again. So I'll slot them in here as such, minus 200 here, and then I will have admin expenses plus 200. So we're just looking at the first half of that suspense account. Part 5 then. So this part 5 will actually, we'll need to do the next part before we can complete this. So a bad debt of 500 should be written off. Bad debt's written off, €500 here, and we will minus that €500 from the debtors. Now we can't do the provision at 5% for bad debts 5% because we have to do the following adjustment that relates to debtors. So we have to wait to get the final debtors figure before we can do that. So note 6, it was discovered that goods which cost the firm $6,500 to produce were sent to a customer on a sale or return basis. These goods were charged to the customer in error at cost plus 20%. Okay, so again, the bookkeeper entered a credit sale when they really shouldn't have. So sale or return means that it's an agreement between the buyer and seller. It means that the buyer should not be charged unless they sell the goods. So the sale or return, when you see sale or return, it shouldn't have went down as a credit sale. So we have to rewind the credit sale. So we need to add the closing stock back to finished goods, okay? Or that's the cost to produce in this case, all right? That will also go down here, closing stock of finished goods. Whenever we get our final figure, that'll go down there. But we have to minus the selling price from the sales and from the debtor. So how we get the selling price? Well, it's the cost to produce multiplied by 120%, okay? So that would be 7,800 that we need to take away from sales and debtors. So our final debtors figure is 56,000 euro here. And now we can do our bad debts provision. So we minus 2,800 from our bad debts provision. And we have to put that into bad debts provision in selling distribution, 2,800 there. So that is that. Now, in 2008, we had one adjustment. So we have debtors and we have bad debts provision here. So note 9, a cheque for 600 euro had been received on the 31st of the 12th, 2007 in respect of a debt of 1,000 previously written off as bad. The debtor has agreed to pay the remainder within 1 month. No entry was made in the books to record this transaction. Okay, so our bank figure from our trial balance was on the credit side and it was 15,900. So we received a cheque of 600, so that would reduce our bank overdraft. So the debtor has agreed to pay the remainder. The remainder was 400 because the debt was previously 1,000 euro and they received 600 from the debtor. So we add the 400 back to the debtor. And in the add operating income, we put bad debts recovered. We put all of it. Okay, so the entire 1,000% there. Right, in 2007, we have two adjustments here. So we also have bad debts provision there in the trial balance. So adjustment number 7, part 2. A credit transfer of 750 euro had been paid direct to the firm's bank account on behalf of a debtor who has recently been declared bankrupt. This represents a first and final payment of 30 cents in the €1. And then 7 part D, provision for bad debts to be adjusted to 4% of debtors. All right, so a credit transfer of 750 had been paid direct to the firm's bank account on behalf of a debtor who has recently been declared bankrupt. This represents a first and final payment of 30 cents in the €1. Okay, credit transfer paid into the bank. This is a bank overdraft. It was on the credit side of the trial balance. So we minus the 750. 750 that came into the bank, we minus 750 there. Now, we will not receive the other 70 cents in the €1. That will be bad debts written off, 1,750. And that is 750 divided by 30 multiplied by 70 to get what 70% is. So 1,750 there. And then from the debtor, we have to minus the two amounts. So the debtors minus 2,500. So debtors minus 2,500 is credited in the debtors account. This bank figure 750 is debited in the bank account, and this expense, bad debts written off, is debited in the bad debts account. So our debits and credits equal there. Then 7 part D, provision for bad debts to be adjusted to 4% of debtors. Okay, so we have 97,900 debtors. We work out bad debts provision, then 4% of that is 3,916. We compare that to the 3,200 and that is €716, and that is an increase in bad debts provision there. Right, 2006, we have debtors, we have provision for bad debts, and we only have one adjustment here. So provision for bad debts to be adjusted to 3% of debtors. So our debtors 76,500, our bad debts provision 3,900. So 76,500 multiplied by 3% is 2,295. We then compare that to the figure from the trial balance and we get which is 3,900, and this is a reduction in bad debts provision by 1,605. So we put decrease in provision for bad debts into our operating income here, 1,605. Right, 2005, only one adjustment here. So note 4, it was discovered that finished goods which cost €8,000 to produce were invoiced to the customer on a sale or return basis. These goods had been entered in the books as a credit sale at cost plus 20%. Okay, so as you know, sale or return at this stage, you know that it is an agreement between buyer and seller that the buyer doesn't have to pay until they actually sell the goods on. So the seller should not record them as a credit sale, and you can see here the bookkeeper actually did record it as a credit sale. So we need to rewind that credit sale. So we're going to add the closing stock of finished goods back to the cost of the finished goods back to the closing stock figure for finished goods. So that's €8,000 here because it cost them 8,000 to produce. That is also going to affect my closing stock down in my current assets. Whenever you have your final figure here, it'll be the final figure here. What we need to do then is we need to minus the selling price from sales and from debtors. So how do we get the selling price? So the selling price is going to be the cost price to produce multiplied by the 120%. So that is 9,600. So we minus 9,600 from sales and we minus 9,600 from debtors. And that's that done. Right, in 2004, we have our debtors and our provision for bad debts, and then we have two adjustments. So first adjustment here, 5 part 3. A credit transfer of €750 had been paid direct into the firm's bank account on behalf of a debtor who has recently been declared bankrupt. This represents a first and final payment of 30 cents in the €1. Okay, so our bank account in this question was on the credit side. Okay, so that means it was a bank overdraft. So bank 5500 there. Now, 750 came into the bank. So the bank there minus 750. So that is 30 cents in the €1. The business is not going to receive the other 70%. So that is bad debts written off 1750. And then from the debtors, we have to minus €2,500 there because that is the 100%. So the 100% comes away from the debtor. 70% they're never going to receive, that's bad debts written off. And 30% they received into the bank, that's going to reduce the bank overdraft figure. Then we have provision for bad debts to be adjusted to 4% of debtors. So our final debtors figure, 71,400. We multiply that by 4% and we get 2856. So 71,400 by 4%, 2856. We compare that to our bad debts provision of 3600, and that is a decrease in provision for bad debts of €744. In 2003, only one adjustment here. So provision for bad debts to be adjusted to 4% of debtors. So our provision for bad debts was already 3800. So provision to be adjusted to 4%. So no effect, nothing happened our debtors. So 77,600. So 77,600, that should say 77,600, apologies. So this here is bad debts provision, 77,600. Again, remember that is a typo, apologies, that should say 77,600. I'll fix that in the notes. But multiply that then by 4% and we get 3104. We compare that to the amount that was previously in the trial balance, and that is a reduction in bad debts provision of 696. So decrease in bad debts provision is great. We put that into add operating income there. Then lastly, we have 2002, we have debtors and bad debts provision here, and then we have two notices there. So two adjustments. So the first one, 2 part 3. A credit transfer of €600 had been paid direct to the firm's bank account on behalf of a bankrupt debtor. This represents a first and final payment of 20 cents in the €1. So the bank account amount was 7,400 on the credit side, which means it is a bank overdraft, so it's under a creditor's amounts falling due within 1 year. Credit transfer of 600 come into the bank, so that will reduce the overdraft by €600. So the €600 represents a first and final payment of 20 cents in the €1. So 600 is 20%. So the 80%, it's going to be bad debts written off. So 2,400. So 600 divided by 20 multiplied by 80 gives us 2,400. So that is what we're never going to receive. Then we minus the entire amount from our debtors, €3,000 there. Then we have note 7, provision for bad debts to be adjusted to 5% of debtors. So our debtors here, 67,900. We multiply that by 5% and we get 3,395. So we compare that then to what had already existed in the trial balance, 2,600, and unfortunately the new figure is bigger than the one in the trial balance. So that is an increase in bad debts provision of €795. Okay, so that is the end of the debtors adjustment. So as you can see, you can have up to like 3, and in one stage we had 4 debtors adjustments, so you really need to practice them very well in order to do well in the exam.